Oh.
Okay. Okay. We could hear everything.
Okay. Sorry.
Good
morning. We were muted. Sorry, folks. Let's try again here. Good morning, everybody.
Okay, now I can hear him. So how do I turn it up?
Thank you for coming this morning to the third in a series of FNO Developer Webinar Series. If you noticed, I said FNO and not FANO. That's because they have changed their name and their brand to better reflect what they do as an organization. So from this day forward, the agency will become Finance New Orleans. We are Valerie Robinson and Lucinda Flower.
Morning.
Lucinda, we are the moderators for this program, and Lucinda is an experienced housing policy, advocacy, and communications professional, and she started her own consulting firm 4 years ago and serves clients in grant writing and communications.
Good morning, everybody. This here is Valerie. As you know, Valerie has owned Robinson et al. Marketing and Public Relations for more than 20 years. It's a full range communication services for private, nonprofit, and public sector folks. Good morning. Thank you again for joining us this morning. As we've said, this is a series of webinars that Finance New Orleans is producing to inform the New Orleans development and building community, folks large and small, experienced and less experienced, about FANO, pardon me, I'm gonna get that too, about Finance New Orleans' new sustainably focused direction. We really also wanna get across the message that Finance New Orleans wants to be a development community resource, a community resource for the development community. Finance New Orleans has really created a new platform to work with a wide spectrum of the city's development community. And they want very much to work with a range of folks on a range of projects and to do their best to meet partners where they are.
And besides learning about programs designed to get more affordable housing in New Orleans, we want this to be a forum for discussion and information sharing. If you have any questions or comments during the presentation, please enter them in the chat box at any time, and we'll try to answer as many of them as possible at the end of the program. Now I'm going to turn it over to Lucinda to introduce our speaker.
Okay. And let me introduce, please, Cornelius Payne, who is our speaker today. Cornelius is going to talk about low-income housing tax credits. And as we know, they can be complicated, but what he's going to try to do is break them down for both newer developers and those who are more experienced. And a little bit of background on Cornelius. He's a real estate developer. He owns his own firm. It's called Growing Pains Development. And it's a consulting and market rate development company based here in New Orleans. He's been a project manager in the nonprofit and government sectors. He's worked with the New York City Housing Development Corporation, Enterprise Community Partners, Gulf Coast Housing Partnership, and the Housing Authority of New Orleans. And he's also worked before that with the Federal Deposit Insurance Corporation and with the assistant to the president of the Southern University System. And so with that, I'd like to turn it over to Cornelius. And just so everybody knows, what we're gonna do is Cornelius is gonna do a presentation. And if you have questions, please type them into chat. And when he is finished, we will get to some questions and try to answer all the questions that you have. And also at the end, this presentation is going to be available on the Finance New Orleans YouTube channel too. So If you missed part of it today, or you want to go back and revisit some of the information, you can go back anytime and do that. Thanks.
All right. All right, thanks, Lucinda and Valerie, for the introduction. I'm gonna try to share my screen right quick. All right.
There we go.
All right, so like Valerie and Lucinda mentioned, I am Cornelius Payne. I'm a real estate developer here in New Orleans. And today I'm gonna kind of give a brief overview of the low income housing tax credit program. As you see on the slide, the housing program is basically part of Section 42 of the Internal Revenue Service Code. These credits are usually administered by the State Housing Finance Agency in each respectable state in the United States. And the agency here in Louisiana that housed those credits is Louisiana Housing Corporation based in Baton Rouge. Each year, the state receives an amount of credits annually in tax credits to projects. I believe this year there's a particular credit amount of 10 million in LATAC credits for this year in 2020, based on its current QAP, and QAP is the Qualified Allocation Program, which I'll talk about a little bit more later on in the slides. So the big question we want to know, what do we do with these credits and how can they finance different various projects? So you can use low income housing tax credits to finance new construction and rehab projects. New construction is just as the word is to say, anything ground up from the ground. Rehabs are kind of like rehab projects, existing buildings that need rehabilitation. A lot of folks use these funds for a lot of historic structures here in the New Orleans area. In some cases, you see an acquisition. You can use the credits for acquisition of buying property, but that's a typical rule around that. And I will talk about that, what you need to do if you're trying to use the credits to acquire property, more so buildings and not so land as much. The credits also have primarily been designed to house families, obviously, and families that have different types of folks, folks that are low income, folks who have special needs, and folks who want to live in single room occupancy, and the elderly as well. The credits can be used anywhere in the United States or in Louisiana particularly, in certain urban areas, rural areas, and suburban locations. There are additional tax incentives for projects in high cost and difficult to develop areas, which is some of the things that we're facing here in the New Orleans region with high construction costs. And there are different things you can do. In addition to the low income credits, there are other subsidies that you can use as well, which I will talk about later on. I'm gonna move on to the next slide. So the next question you're probably asking, how do tax credits work? And primarily work with developers who's trying to create housing and trying to essentially create affordable housing and leasing out rental units to folks who are making 60% area median income. And when they lease out these units and leasing them at a discounted rate, in order to make that happen, you have to reduce your development costs. And you do that by having investors, as I have on the second part of the slide. These investors are usually folks in the corporate America world who use a lot of their profit for that particular year, and they're looking for an exchange in credits to reduce their federal tax liability. For example, just to kind of give you a company that probably invests like Facebook or Google, which they have big initiatives now where they're purchasing a lot of credits to show a good community reinvestment, back into the community. And what Facebook and Google would do, let's say they have about $100 million that they want to invest in low income housing development project across the country. What they usually do is hire out a syndicator, and a syndicator could be a company such as Enterprise Community Partners that some of you may have heard of. Enterprise has a fund, and what that fund is, the Facebook contributes the money to this fund. And then enterprise or a Chase Bank who holds the money in these funds go out and shop deals to different developers, such as developers who have acquired credits. And at that point, you know, the syndicators and the fund is looking for good, solid deals that they can invest their money in so they can reduce their federal tax liabilities. So instead of them paying the money to the IRS, they're actually giving the money to a fund so the fund can invest that money into projects, you know, so the projects can get built and ultimately build affordable housing for people in low income or desirable affordable communities. Generally, tax credits are received over the first 10 years of operation. And what that means when a Facebook is invested in a property, they're in it for the first 10 years of operation, and they're receiving reduction in their tax liability, or they're receiving some of the losses to kind of shield some of their taxable income, so they're not paying taxes at a higher rate. And most of the tax credit projects are recaptured by the IRS if the project does not comply for 15 years. And what's meant by that is a tax credit project compliance period is 15 years, according to the QAP, according to federal guidelines and the IRS Section 42. And you have to have this property in compliance as a low income or affordable rental for at least 15 years. When you're developing affordable housing, there are some unit restrictions and thresholds that you have to meet when you apply for the application, which is called, you want to know who can live there. And usually particularly in Louisiana, on that QAP or the LIHTC application, you have to elect a 40-60 election or a 20-50 election. So the question is, what does 40-60 and what does 20-50 mean? 40-60 means 40% of the total number of units can be at 60% AMI or below, or you can elect 20% of the units can be at 50% AMI and below. You may choose to have the whole project at 100%, which means you have 100% of your units at 6% AMI below, which is what a lot of folks have done in order to have a 100% applicable fraction. And I will talk about applicable fraction and what that means later on as well. The rents are usually restricted, and that's basically how much can tenants pay. Rents and utilities are usually limited to 30% of the person's household income, and it depends based on the size of the unit that's in the development. So kind of let's just look at an example of what I kind of just mentioned about tax credits and how this is kind of like a financial chart, a small one of showing how what the investors and what are they getting for investing into these projects. So on the left-hand side, you see at the top, you see a no tax credit / no deduction. This is more so like a market rate deal with no low income units in it at all. It's just straight market rate development. They're not using any subsidy, any tax credits. To the right, you see the one that says additional deductions and credits. This is that of what a low income project financial will look like. If you notice between the two, and you look down to the net tax liability, the person who has no tax credits will have to have a tax liability of $400,000, whereas the person who the investor who takes on investing in some credits, which is about $300,000 this particular project, even though their tax rate is at $280,000, if they were given $300,000 in credits per year over the 10 years, they're reducing their tax liability by $20,000. So they actually have a negative $20,000 in tax liability, which they can carry forward to year 2 on their taxes for this particular company. This is why a lot of companies such as Facebook, Berkshire Hathaway, Google, and you see a lot of these companies, instead of them giving the money back to the IRS, they like giving money to developers and to contribute to funds, so the funds can give the money to developers so they can receive this credit in order to reduce their net tax liability. So how does the structure of a tax credit syndication works, basically, right? There's usually a partnership, and usually the general partner owns 0.01%, and that person controls or operates the project. That person is the developer, and the passive limited partner invests the equity in return for 99.99%. That person is the investor, and that person, think of, is Facebook or Google or whoever contributes the equity into the project. So the sale to the investor limited partner of the most of the tax credits and tax loss maximizes the investor's equity. And what I like, the example I just showed a couple of slides ago, when they invest their cash into the fund, they're able to receive a certain amount over a 10-year period of the credit that they can take on each year, so they can reduce their tax liability at their companies. The limited partner is just a passive investor and gets a return almost exclusively from the tax credit and the losses. And more investor equity reduces other finance needs, and it helps the project development. So the more equity they receive, the more or less money that they have to go seek after in a development project. So here's a diagram to kind of explain a little bit better, giving you a visual aid. You know, you can talk words and listen to me talk, but kind of seeing what's out there, seeing it probably gives a better picture. So for example, you have the investor who I've been mentioning Facebook as the example. Facebook would contribute their money to an equity fund. The equity fund could be like Enterprise Community Partners, who has an investment fund, or it could be Chase Bank or Capital One or any of these banks that also holds funds for the investor. Once those funds are gone into the equity fund, the limited partnership is the investor, which is Facebook. The GP is the enterprise meaning your company as being a developer. And then the funds are floated into the project. As you see the arrows, that money goes into the respective development. And that's essentially the basic structure that you would use, or you would have your tax attorney to use when they're drafting up a partnership agreement. And that's what you would have to go into. And this is how it's spelled out. You would do a partnership agreement with the LP and GP, explaining out all the terms, the percentage ownership, and also what are the operating agreement of the development. So the next question is, who are the parties in a tax credit syndication? So the development team, as a developer, the development team is usually the real estate developer who's the leader. Then you have the general contractor, you have the architect, attorney, the accountant, property manager, and consultants. On the lender side, you will have a construction lender who does the construction of the property. The permanent lender is the person that takes out the money from the construction to make it a permanent term loan. And then you have the bank attorneys who are representing the banks. You also have the State Housing Finance Agency, which would be Louisiana Housing Corporation. And then you have the syndicator. A syndicator is what I mentioned before, would be like an Enterprise Community Investment, or Chase Bank has a syndicating division. And these folks are the underwriter, the fund manager, and the people who hold the funds from the equity that they receive from companies like Facebook. And obviously these folks also have their own attorney as well. So now we're going to talk about the two different types of credits that you can apply for. There's a 9% credit and a 4% credit. The 9% credit is the most competitive one and the most popular one. And the 4% credit is a credit that is combined with taxes and bonds, and it's a non-competitive application. First, let me go back up to the 9%. The 9% credit is a competitive application that's usually one round through the Louisiana Housing Corporation. They usually administer what's called the QAP, the Qualified Allocation Program. Currently, right now, I think they're in place of folks are writing the application. So I think the deadline is coming up pretty soon. So if you're not in process of doing an application, you may have to wait into next year application that rolls out, but it still would be good for you to look at the QAP to kind of get yourself affiliated and adjusted with the language and kind of looking at what's going on and kind of studying it, like kind of think of it as like a tax credit Bible into the low income housing tax credit world. If you do not want to do the 9%, which I said is a very competitive application, you would have a high number of developers going after these funds, because this can essentially really finance a substantial amount of the project. It may only leave you with $1 million or $2 million gap in the project. So you see a lot of developers all across the state competing for this credit. It can be very costly sometimes. Sometimes it can cost about $10,000 to $15,000 for someone to write the application for you. There are a number of documents you need, and there's some other studies that have to be conducted prior to. So it's really good that you look at the QAP so you have the tools in place when it's time to apply for the application. On the 4% credit, like I said, it is financed with taxes and bonds. I'm not going to go too much in bonds today. I think the next series, FNO series or Finance New Orleans series, would dive more into taxes exempt bonds and how they can be combined together with the low income housing tax credits. Unlike the 9%, the 4% is not competitive. You can just go straight to the Louisiana Housing Corporation to apply for the 4% credits or the taxes and bonds. Or we have this new great program at Finance New Orleans where you can come to the Finance New Orleans and apply for tax credits and bonds as well. So one of the great things about developing in the New Orleans market, you have two options of coming to Finance New Orleans to apply for bonds and try to couple them with low income housing tax credits at the 4%. Or you also can look at the state level at the Louisiana Housing Corporation. And if you have any other questions about the tax bond and maybe working with Finance New Orleans, please feel free to reach out to some of the employees or getting more information from Valerie and Lucinda on how to do so. Let's see. Go down. So let's talk about calculating basis and what is basis. When you're trying to calculate how many credits you need for low income housing tax credits, within the IRS code, they look at what's called basis, and basis is what's depreciable of basis of residential rental housing eligible for tax credits, right? And what you're looking at, what things are eligible and what was not eligible. And I'm trying to find the slide. It looked like it got mixed around, but I want to show you what's eligible. Here it is right here. So these are the things, pretty much everything is eligible in basis, such as construction costs, attorney fees, survey fees, permit fees. Acquisition of the land is not included. Land by itself, if there's a building, a vacant building, that's not included in basis. If you receive historic tax credits, that's not included. Fees on your permanent loan is not included, but if you have a construction loan, you can include the interest on the construction into basis. So what you see on this slide, some of the syndication costs, tax credit fees, reserves, and federal grants, all that stuff is not included in basis. But as I mentioned before, you can use construction costs, construction interest, survey fees, permit fees, and trying to think what else right now. You also can use architect fees, engineer fees. All those fees are all included in basis. In addition to basis, you can also include your impact fees. Impact fees, or here in New Orleans, we're doing this big thing on infrastructure and stormwater fees, right? So stormwater can be included because that is a part of infrastructure. You can include those fees into basis. The on-site that you may have on the property, such as sidewalks and parking lots, the cost of utility hookups, landscaping, if it's adjacent to the building. So what I mean by that, if the landscaping is attached to the building or somewhere around the building within the site, but it's not paying for the landscaping that's within the sidewalks or out in the public right of way. You also can include the common area of the building. So if you, in the full-time manager unit in a community space. So let me talk about that. The common area meaning like the stairwells, if you have an open area, your lobby, if you have some offices for, if you're giving some social services, or you have a full-time property manager on staff, you can include that in your basis. If you have a community space, so that's a community room for people, with a workout room or a room where it can be used by the community or the community at large surrounding the city. You can also include that in your basis as well. So, okay. So some example of the community space that people would like to be more specific about. Sometime in some of these projects, a project that I've done in Baton Rouge was called the One Stop Homeless Center. And the second and third floor was 36 apartments. But on the first floor we had what's called a lot of community facility space. And in that space, the tax credit basis and the tax credit allows to build a community service facilities that included, excuse me, a medical clinic, a dental clinic, and also we had a lot of social services. So there were like 15 offices for social workers. There were folks there to do financial fitness, folks there teaching financial literacy and computer training. And also there was some Meals on Wheels from different programs. They get food from, from counseling on aging and other social services throughout the state. So you can include all, if you're going to provide some services that's providing a direct impact or a direct service to folks that's living in those development communities, or folks that live around the surrounding community, then you can also ask for that type of money in your basis, so you can increase your tax credit amount when you ask for it. So when you finish calculating your basis, you want to make sure that your project is in a qualified census tract. And the qualified census tract is usually, you can find if you're in one by going to novogradic.com. If you go to Novogradic, you can type in the address of your particular site. And in the site, you can put in the address, excuse me, you can put in the address and find out if your property is qualified for, in the census tract. And what that means, if you find if the property qualifies, you can get what's called a basis boost in your basis of about 130%, which helps you increase your basis in order for you to yield more credits for your project. So that's something, I have it posted. I have the link posted in somewhere in one of the slides, but you'll be able to go to it, look up your project first and see before you buy the property if it's in a qualified census tract or not. So the acquisition basis, when I was talking about you can use the credits to acquisition rehab. So you can use the credits to acquisition an existing or a vacant building, but the catch to it is the building has to be substantially in rehab. And there's a definition in the QAP that defines what substantial rehab means. Two, the building has to be in title of that person's name within 10 years. It has not exchanged title within the past 10 years, which will be verified by a title attorney. So if you know of a property that is vacant and if it's been with the same owner for 10 years, it's possible that you can possibly use credits to do an acquisition rehab credit in order to acquire that building. So you may not have to use cash out of your pockets. You can use this program to help you acquire the building. In this case, no basis boost is permitted for the project acquisition basis. That's for the acquisition only. So now I'm showing you an example of how folks calculate a tax credit numbers. So in this particular situation, let's say you have a budget of a project at 9.6 million. You minus out your ineligible costs, right? The ineligible cost is the land, as I showed you on one slide. It could be the land, it could be your permanent loan fees, and et cetera. And then from that, you have the eligible basis. The eligible basis is, as I mentioned earlier, anything from your construction costs, construction interest, attorney fees, permit fees, stormwater fees, and you take that number of the eligible basis and you multiply by the applicable fraction. That means this particular at 100%, that means this project is 100% affordable housing, 60% AMI and below. And it looks like this property falls within a qualified census tract, so they get 130% basis boost. So it gives them a qualified basis of 11 million. You see that they have the qualified basis of 11 million. The applicable rate, which is a rate that fluctuates every month, and Novogradac and Enterprise and some of these journals post whatever the fluctuation of price of credits is going on, there's a monthly rate. I'm just using this as an example of 9%. Sometimes it can be at 9%, sometimes it's at 8.58. You have to check it on a monthly basis to see what the rate is at that particular month. So I'm using 9%. So you look like you qualify for $1.2 million in annual tax credits. And remember, you can get the tax credits. The tax credits the investor is in for 10 years. So you take $1 million that first year times 10, and then you get about 10 million in tax credits for the project. So you have those tax credits at 10 million. You take those credits that hopefully that you get from you get a reservation letter from Louisiana Housing Corporation, and you go shopping around to these different funds like Enterprise Community Investment, Chase Bank, Capital One, and they take the property, they take the reservation letter and take a look at it, evaluate it, look at the project, look at your development team, and they give you a price on how much they want to purchase the credit for. In this particular scenario, I use 80 cents on a dollar. So they would give you 80 cents on a dollar. And now you have about $8 million in equity going into your $9 million projects, which leave you about $1 million gap that you have to plug in. So when structuring the project, is basically essentially what you do is step one, you need to estimate your tax credit basis. And two, estimate the tax credits generated. Three, estimate the investor equity, which you could do by talking to a fund manager. And number four, estimate your first mortgage amount. And that comes from finding out what is your gap. And then five, estimate the funding gap. You may want to not use first mortgage. You may want to use some other type of funding that's out there, such as CDBG and home funds that the city and the state usually release a funding availability notice every year. And you can use this money to fill the gap with a combination of other funds, which is step 6. So you're probably wondering, scratching your head, well, what are some of the other funds you can fill the gap with? Like I mentioned, you can fund it with the home funds, and there are home funds at the state level, and there are home funds at the city level. You can also use CDBG funds, which is called the Community Development Block Grant Program. They have state CDBG programs, and then they have city CDBG programs. You also can use AHP funds. AHP is called the Affordable Housing Program. It is with the Federal Home Loan Bank of Dallas. You can match those funds for a tax credit project as well. Sometimes there's TCAP and exchange funds. I haven't seen those funds in a while, but those were special funds that were created by the federal government and the Treasury Department after the 2008 recession. Sometimes there are recycle funds that can be used again that the Louisiana Housing Corporation issues out. So you just have to be on the lookout, kind of inquiring for those particular funds. Also, you can defer your developer fee to try to reduce your gap cost savings, such as trying to get that contractor to go down on the construction costs, or maybe try to acquisition of property at a lower cost. And also you can try to modify your first mortgage terms with your bank when you're getting your permanent loan. Maybe look at trying to get a cheaper interest rate or a longer amortization, such as a 25-year amortization or a 30-year amortization, if you can find some flexible lenders out there. So here's the tax credit timeline. Apply for the tax credits first. Once you do that, you want to get a tax credit reservation. And then you want to try to receive your carryover allocation and incur more than 10% by a required date that's set by the Louisiana Housing Corporation. You want to complete the project and place it in service. And the Louisiana Housing Corporation will let you know when they want the place in service to be by. So they give you all these benchmarks and requirements that you need to meet, as well as your investor will give you benchmarks as well on contributing the equity into the project. Once the project is completed and you place the building in service, you will apply what's called an 8609. And 8609 is basically your ticket saying that you have completely successfully used the credits and have been in compliance. And you need this 8609 for the IRS to know that you have successfully did what you needed to do. You have complied, you have built the building, you have leased it up and got it all stabilized. And once you have that great piece of paper that's worth $1 million, because trust me, it's a lot of work to get there, you will have to record an extended use agreement. And what an extended use agreement is on some of the funds you may have, such as if you go to the city for CDBG or for AHP funds, even though low income housing tax credit, the compliance period is 15 years. Sometimes with CDBG and affordable housing program funds, the compliance period is 35 years. And they want you to extend a extended use agreement saying that you would keep those rents at those rates for 35 years or longer. I think pretty much that's pretty much all I have for right now. I just have some definitions of things that you may hear throughout your journey of trying to go into a low-income housing tax credit project. One thing you may hear that's probably confusing to a lot of people, what is hard debt versus soft debt? Let me talk about that before I think we got some questions. So hard debt is the money that must be paid back to a conventional bank lender, and is generally amortized. So what's mean by that? If you go to a loan like Whitney Bank or Iberia Bank and you get a loan for a project, well, they're loaning money from the bank and you have to pay them back. And those folks are usually always in first position on projects. Soft debt or grants and soft loans that's coming from the government. And soft loans can be in the form of CDBG loans, home loans, and these loans are based on the cash flow of the project. If the project is not cash flowing, the government usually waives that debt for that particular year, but you have to show evidence that the project is not cash flowing. In terms of grants are usually not repayable. And those are the three different terms that you'll probably hear a lot going through the tax credit process and kind of explaining the three different types of subsidies. So one is hard debt, One is soft debt, and one is grants. I'm gonna stop right there. I think we have some questions, and hopefully I'm giving you a general idea of the low-income housing tax credit program. So,
Lucinda, I'm going to squeeze in here with Cornelius. And I know somebody asked about whether or not this was being recorded. And yes, it is. It's going to be available on Finance New Orleans YouTube channel. I also just wanted to ask Cornelius, if I'm a brand new developer, I hear about this great concept, low-income housing tax credits, but I've never used them before. What would be the first step you would recommend?
My recommendation would be, like I said, go to Louisiana Housing Corporation and go to the qualified allocation program and just start getting familiar with the application and looking at the guidelines and set forth. And go to the meetings. There's usually meetings once a month or once every 2 months. And go there and get to know some of the developers, talk to people, and get to know the players, the architects is there, the attorneys, and just meeting with people, you'll find out that people are very receptive to helping you. And because sometimes if it's your first development, it's a lot of fees that goes into these projects that a lot of people don't talk about. And sometimes you're going to need to have somebody hold your hand on probably the first 2 developments because the investor may not be comfortable with you. But if you can try to go meet some of the well-known developers, in the state, maybe you go out and try to find the land for the project or a building and say, hey, I have this project, I own the land, or I have it on a contract for a building. And I think, you'll find that people are like, okay, well, maybe we can partner some type of way on the project. So that's my advice to small developers. Don't feel like that you can just come in and, pick up the ball, run it, and maybe do a project. You may have to partner with somebody for the first 2 times to kind of understand this complex process and understand how to get a deal done, and to also have a investor be very comfortable with giving money to you, because they're not going to give money to folks who haven't done a project on this scale, but it can be done. Don't let it discourage you.
And also, thank you, Cornelius. I guess also you mentioned something about the QAP, the $10 million QAP. You were talking about that. Is that for 2020? And is that fiscal or calendar year? Do you know?
So it's usually it's by fiscal year. So they have released it for this year, but I think from what I've heard, I think they may be combining and increasing that amount, but it is by fiscal year. So it usually comes out between March and July. They usually release the number, and that's the particular number for this year.
And people would go to the Louisiana Housing Corporation website to find that.
Right? Correct.
Okay. All right. And also, you mentioned another site. You mentioned qualified census tracts. Do you happen to know where people can find information on that?
Yeah. But they can go to user.gov, and I think those are the main 2 that I know. Websites, so folks can have it as a frame of reference to see stuff on the property before they acquisition about it to make sure it's going to qualify census tract.
Yeah, and finally, I think we just want to reemphasize that Finance New Orleans really wants to be a resource. So if you really are just trying to figure out where do I begin, I would say the best thing to do is you can always go ahead and contact Finance New Orleans, and we can help direct you from there and kind of work with you, as we said earlier, work with you where you come from. We want to meet everybody where they are in terms of their experience, their background, their etc., what kind of deal they're trying to do. So we really, there's one thought. We really want to be able to work with folks as much as we, want to be able to work with folks as much as we can, I guess. And with that, I think that is it. Thank you, Cornelius. And I do want to mention that we do have another webinar coming up a week from today. That's kind of 3B, the other side of the tax credit. We talked about tax credits today, and then next week we're going to talk about federal agency credit enhancement products, which are related. So we're kind of looking at it as 3A and B. And with that, I think we want to thank everybody for joining us today, and hopefully we will see you next week. We'll also, again, this will be available on Finance New Orleans YouTube channel. And we will also be sending along some information on, we mentioned that they have rebranded from FNO to Finance New Orleans. We're going to send you a little more background on that, so you just kind of get the picture of, you know, why that's been done and where we're going from here. So thank you, everybody.